In October, we begin working on final income and tax projections for our clients and suggest strategies that help minimize their taxes before the year ends. Even though we have about 3 months left, the implementation of some strategies will require preparation and time. So it's good to be proactive and don't miss any opportunities to cut your federal tax bill. Before we jump in, remember that tax planning isn't just about cutting this year's tax bill. It's about reducing your lifetime tax bill. As I share with you a few tax strategies that have worked well for our clients, think about how they might fit your own situation and consult with your advisors before taking action. To get started, I'll go over a few tried and true foundational strategies. Due to the high standard deduction, many retirees stopped itemizing their deductions after the Tax Cuts and Jobs Act. However, by being strategic with your deductions, you can still find a way to reduce your tax bill. For example, if you can pay your January 2025 mortgage payment before the end of December, this would allow you to include the interest portion as a deduction on your 2024 Schedule A. State and local taxes are limited to $10,000, but if you are under this cap and if allowed in your area, consider prepaying your property taxes due in January in December to include them in this year's deductions. If you are charitably inclined, consider bunching multiple years of charitable donations into 2024 to exceed the standard deduction. For example, if you usually donate $5,000 each year, consider donating $15,000 in 2024 instead. This way, you exceed the standard deduction and can itemize, maximizing your tax benefits this year. Then, take the standard deduction for the next 2 years. If your medical expenses are close to or exceed 7.5% of your adjusted gross income, it may be beneficial to pay for additional treatments or procedures before the year ends to maximize your deductions. For instance, if you know you'll need surgery soon, why not to get it done this year rather than putting it off? In this day and time, going green can be highly rewarding thanks to various government tax credits. Unlike deductions, tax credits directly reduce your tax bill dollar for dollar, making them especially powerful. If you're considering a new car, look into buying an electric vehicle. You could qualify up to $7,500 in credits for a new EV, or up to $4,000 for a used one. Be sure the vehicle meets the criteria and the price does not exceed $55,000 for sedans and $80,000 for SUVs, pickups, and vans. Another option you can do is to transfer the credit to the dealer in the time of purchase to reduce the car's price. You can also earn credits by making your home more energy efficient. The Residential Clean Energy Property Credit lets you deduct 30% of the cost for installing solar panels, solar water heaters, and other eco-friendly systems. Additionally, consider reaching out to your electric company to see if they offer programs to help offset installation costs or provide solar incentives. There is also the Energy Efficient Home Improvement Credit, which covers insulation, boilers, doors, windows, and similar improvements. Previously capped at $500 for a lifetime, this credit now offers up to $1,200 annually. If you're considering several upgrades, spread them out over 24 and 25 to maximize your benefit. If your company offers a deferred compensation plan, consider using it. This plan lets you set aside part of your salary into a tax-deferred account, allowing it to grow tax-free. While you pay taxes when you eventually withdraw the funds, the contributions are not taxed when deferred, allowing for years of tax-free compounding. Another way to lower your tax bill is to delay an extra income until next year. For instance, ask your employer to postpone a year-end bonus or wait to get paid for freelance work. You can also hold off on selling investments to defer capital gains. Or, if selling your home, try to push the closing into the next year if possible. Essentially, defer any income or gains if you expect your tax rate to be lower or unchanged next year. When it comes to charitable giving, you need to be strategic, as making the wrong decision could result in more money going to an inefficient government than to the causes you care about. First, avoid donating assets that have decreased in value. Doing so will result in wasting your loss that could offset gains elsewhere in your portfolio. Second, instead of donating cash, consider gifting appreciated assets like stocks or mutual fund shares. If you've held the assets for more than a year, you can usually deduct their full market value if you itemize deductions. Plus, you will avoid capital gains tax, leaving more money to support your favorite charity. If you want to take it a step further, consider setting up a donor-advised fund. By making a large donation to a donor-advised fund in 1 year, you get an immediate tax deduction. Then, you can invest the funds inside the donor-advised fund, let it grow tax-free, and give away the money to your charities over time. This strategy is particularly useful in a year with unusually high income, as it can push you into a lower tax bracket, saving thousands in taxes, just like it did for one of our clients last year, and likely will again this year too. If you have highly appreciated assets and want to manage gains and smooth out income between tax years, consider using charitable remainder trusts. I'll dive deeper into this advanced strategy in my future videos. You also need to be mindful of the required minimum distribution rules for traditional IRAs, as the Secure Act 2.0 has introduced significant changes to how and when RMDs must be taken. Currently, individuals age 73 and older are required to take annual distributions. The same rules generally apply to 401k plans. However, if you are still working past 73, you can usually delay RMDs from your current employer's 401k until retirement. If you turn 73 in 2024, you can delay your first RMD until April 1st, 2025. By doing so means you'll need to take 2 distributions in 2025, the amount for 2024 plus the amount for 2025. Think twice before delaying, as doubling up your distributions could push you into a higher tax bracket or reduce certain income tax deductions that phase out at higher income levels. On the other hand, delaying could be beneficial if you expect to be in a much lower tax bracket in 2025 because you plan to retire later this year. A great way to manage income from RMDs and reduce your tax burden is by making charitable donations directly from your traditional IRA. Individuals age 70 and a half and older can transfer up to $105,000 per year from their IRAs to a qualified charity through a qualified charitable distribution. These distributions count towards your RMDs, but are not taxed or included in your adjusted gross income. QCDs are especially beneficial for taxpayers who take standard deductions, as they still provide a tax advantage from charitable contributions. Another option available to IRA owners is a one-time qualified charitable distribution of up to $50,000 to fund a charitable remainder trust or a charitable gift annuity. Keep in mind that this is a one-time opportunity, not an ongoing annual option. Here's an easy win. Be sure to maximize your 2024 401k and IRA contributions. You have until December 31st to make 401k and other workplace retirement plan contributions, and until April 15th of 2025 for IRA contributions. The 2024 contribution limits are $23,000 for a 401k or $30,500 if you are 50 or older, and $7,000 for an IRA or $8,000 if you are over 50. If you want an immediate tax break, a traditional IRA is the way to go. However, if you are covered by a workplace retirement plan, like a 401k, your ability to deduct contributions begins to phase out at $77,000 for single filers and $123,000 for married couples filing jointly. If you are eligible to contribute to a Roth IRA, you won't get an upfront tax deduction, but your investments will grow tax-free. Additionally, unlike 401ks and traditional IRAs, Roth IRAs do not have required minimum distributions, which makes it a great inheritance planning tool. Another powerful strategy to reduce taxes both now and in the future is to utilize a health savings account. If you have a high deductible health plan and have already maxed out your 401k plan and IRAs, be sure to fully fund your HSA as well. In 2024, you can contribute up to $8,300 for families and $4,150 for individuals, plus an extra $1,000 if you are 55 or older. HSAs offer a unique triple tax benefits. Contributions are tax deductible, the funds grow tax-free, and withdrawals for qualified medical expenses are also tax-free, something no other account can match. Because of these benefits, we often advise clients to let their HSA balances grow for as long as possible, instead of using them now to maximize long-term tax savings. On top of that, you can make a one-time tax-free transfer from your traditional IRA to your HSA, up to your annual HSA contribution limit. This strategy converts pre-tax IRA funds into HSA dollars without triggering taxes or penalties, and can provide long-term tax benefits. Consider whether it's a good time to convert your traditional IRA to a Roth IRA. While you will pay taxes on the converted amount, future growth and withdrawals will be tax-free. Key factors include current and future income tax rates. If you expect your retirement rate to be same or higher, a Roth conversion can be beneficial. Roth IRAs also do not have required minimum distributions, unlike traditional IRAs. Keep in mind that the conversion amount increases your adjusted gross income, which could raise Medicare premiums 2 years from now. With the strong performance in the stock market this year, my guess is you likely don't have many unrealized losses to harvest and offset your gains. However, the situation can change before year end, so keep an eye on your positions, and if you see a loss, consider realizing it. This will offset capital gains, or up to $3,000 can be used against your ordinary income, with the excess carried forward to future years. But be cautious of the wash sale rule, which disallows a capital loss if you buy substantially identical securities within 30 days before or after the sale. However, the disallowed loss is not lost forever. It's just suspended and added to the cost basis of the new shares. Although I'm a proponent of index investing, I understand that active funds can be useful in certain situations. However, if you hold high turnover mutual funds in your taxable account, consider selling them. Since these funds frequently buy and sell stocks, they generate taxable gains that are passed on to you, potentially increasing your tax liability. You might also consider realizing some gains. Why? Because if you are a single filer with income below $47,025, head of household with income under $63,000, or a joint filer with income under $94,050, you could qualify for the 0% rate on long-term capital gains and qualified dividends. This means you won't pay taxes on the gains and reset your cost basis, which could lower future tax liabilities for you or your heirs. However, watch your adjusted gross income closely. Even if you qualify for the 0% rate, additional gains can push your adjusted gross income higher, moving you into a higher tax bracket and negating the benefit. This could also trigger the Social Security tax torpedo, making more benefits taxable, and may increase your state tax bill, as some states treat capital gains as ordinary income. That's why we run detailed projections to keep a safe buffer and avoid pushing clients into a higher bracket. If your modified adjusted gross income exceeds $200,000 as a single filer or $250,000 for joint filers, take action to reduce the 3.8% surtax on net investment income, like dividends, interest, capital gains, and passive rents. Along with the strategies I've already mentioned, you could also invest in municipal bonds, as their tax-free interest is not subject to the 3.8% surtax. If you are interested in investing in real estate, think about investing in real estate investment trusts. They are easy to invest in and offer a potential tax break. You can deduct 20% of qualified REIT dividends on your federal return, as long as they are not already taxed at capital gains or dividend rates. Similar tax benefits apply to publicly traded partnerships as well, making them another option for tax-efficient income. If you are open to investing in a qualified small business like startups, early-stage companies, venture capital funds, or crowdfunding platforms, consider buying qualified small business stock. While it will not offer any tax benefits this year, it can be highly effective in the long run. This is because you can potentially avoid paying federal capital gains tax on up to $10 million of gain, or 10 times your basis in the stock, whichever is greater. And also you avoid the 3.8% net investment income tax if the stock meets the criteria under Section 1202 of the Internal Revenue Code. Year-end tax planning isn't just about saving a few dollars here and there. It's about strategically positioning yourself for long-term financial success and minimizing the amount you give to Uncle Sam over your lifetime. Each of the strategies I discussed today has its nuances, and what works best will depend on your unique financial situation. Before making any moves, be sure to sit down and run the numbers to see which strategies align with your overall financial goals. Remember, the clock is ticking, and some of these opportunities won't be available after December 31st. So take action now to make the most of this year. That's all for today. If you found this video helpful, don't forget to hit the thumbs up and subscribe to my channel. And if you'd like to learn more about how we help our clients protect their wealth and create a lasting legacy, be sure to visit us at www.lestna.com. Thanks for watching.